I'm going to get started now. I know it's just before 7:05 here. Thanks for coming out. Really appreciate everybody taking some time out of this beautiful September day to learn a little bit about private lending. So I'll be talking about becoming a private lender, what private lending is all about, and how you can earn between 6 to 12% by being the bank. So welcome to my presentation. Thanks for coming out. I'm going to talk about first what A, B, and private lending is all about, and the differences between A lending, B lending, and private. I'll talk about what exactly is private lending, why somebody should use a private lender, why you would want to become a private lender, what are the risks, some examples of some deals that we've done and funded, what a MIC is, a mortgage investment corporation. And then comparing your options and different investing options, which would be like purchasing rental properties, investing in a private loan itself, investing in a MIC, or investing in stocks, and last but not least, how you can get started. So first of all, let's talk a little bit about private lending, what private lending is, and the difference between A, B, and private. So first of all, an A lender would be anybody that you would consider to be a bank, a credit union, what we call non-bank lenders, which are only accessible via mortgage brokers. And typically an A lender is going to be in the best rates category, and they also have the tightest underwriting policies. And so in general, lenders that are in the A space, they are usually more heavily regulated by government entities, tighter restrictions on what kind of lending they can do. You typically have to fit the box in order to get financing on A lending. And an important key feature that I want to talk about, which really helps you understand how A, B, and private works, is the underwriting, or the qualifications are very client-focused and moderately properly focused. What I mean by that is that most of the underwriting looks at the individual, and if they like the individual, then usually as long as the property is meeting bare minimums, then they'll lend to you. And you're going to find that over time, as you get into the B space, that starts to change. So a B lending, in B lending, which should also be called subprime lending, there'll be alternative lenders like Home Trust, Equitable Bank. Sometimes certain lenders will have an A lending division and a B lending division. For instance, Blue Shore Credit Union has Blue Shore Pacifica, which is a B lender, an alternative lender that they use underneath their same credit union brand. So there's many different lenders that do this. But for the most part, B lenders are usually a separate entity. Usually A lenders, if that doesn't work, then usually skip right into B. And you can expect that usually rates are about bank rates plus 1 to 2%. Fees are usually 1 to 2% of the loan amount. However, there's way more flexibility with the client themselves with B lending, and that would be on their credit based on their income. As an example, with B lending, if you're self-employed, they can actually use between 6 to 12 months of your bank statements to determine what your income is, as opposed to looking at your tax returns. And this is very important for a lot of our clients that are self-employed, that have a recent trajectory upwards or are very new in their business. And that's probably the main reason that we would use a B lender, is that they still need to use some kind of income to qualify you, and they need to see that it's coming in the door, but they're much more flexible with how they treat that. Whereas banks, it's pretty straightforward. If you're self-employed, you generally need to show a 2-year history of that self-employment income to be able to use it. So B lenders are a bit more flexible, but obviously at a cost. And last but not least here, they're a little bit more property focused. So a little less focused on the client, a little bit more on the property now. And what you'll find is that in many cases, B lenders are a little more restrictive to which lending areas they have. If the population is less than 50,000 people, it's often very difficult to get a B lender to lend in those smaller communities because the properties are a little less liquid in smaller markets. Last but not least here, we have private lenders, and this would include a mix, mortgage investment corporations and individuals, so private lenders. And this is where you're going to see the highest fees, 6 to 12% interest rates. Fees of usually 12 or usually between 2 to 3%, but sometimes they can be as high as 5%. In fact, recently I saw a deal that had an 8% fee attached to it. It was a quite an expensive and very risky file that we saw. So much higher fees can apply in certain circumstances, but in general, 2 to 4% is generally what I see for private lending. It has minimal client underwriting. In fact, in many cases, we need very minimal documents or sometimes no documents at all from the client other than their application and their credit bureau. And sometimes you just need to prove that they don't owe any taxes. Sometimes the certain lenders will have slightly lower interest rates if it's underwritten a little bit, where they actually do gather some documents like the client's income and a few other items. But for the most part, it's entirely property focused, which can be good or bad. Sometimes we'll see that if a client doesn't quite fit in with an A lender in a small town, sometimes we find that there are actually no options because the B lenders won't go there and the private lenders won't go there either. So sometimes we'll find that if you're, again, a borrower that's right on the cusp trying to buy in a small market, you can find that sometimes it's A or bust for you because the B lenders and private lenders often won't go there, or they'll only go there if they lend a certain amount. And so it's an important observation, and we'll start to talk a little bit more about how the underwriting is very different with private lending. But just a quick key difference on what categories are we dealing with here. We're dealing with A, B, and private. So let's talk a little bit about the types of private loans and loans that we see. There's many different things that we observe, and this is just a quick hits on some of the things that we see. But deposit loans is a big one. That is when a borrower is purchasing a new residence and they need a deposit on their purchase. So not the down payment, but the deposit. And they may not have that money accessible to them, but they do have it in equity in their existing home. So our office does deposit loans quite frequently. Private lenders do deposit loans where they can get short-term funding to cover them off until their existing property sells. Flips is very common, especially because the interest rate is high. But if the interest rate is high, but only for a short period of time, if you're only borrowing the money for 3 or 6 months, then the actual accrued amount of interest is not that much higher than it would be if you went with an A lender. In many cases, if the property is in really rough shape, it's very difficult to get a bank to finance it. Whereas a private lender, if you come to them with a really solid game plan, could be more willing to do a private or could be more willing to do a flip for you. And so sometimes we have this conversation with our clients where we say, hey, look, the financing cost will be more expensive for you to get financing on this particular property. However, if you look at the type of deal that you got, if you think you're going to make $100,000 by doing this deal and your financing costs are going to be $10,000 higher, well, maybe it cuts into your margin a little bit, but you're still better off or best off to still do this deal. And so we do find that for flips, often we're doing flips because the cost of the borrowing doesn't accumulate as much because it's a short turnaround on a flip. And number two, often the major banks won't do them. In fact, if you tell the bank up front that you're doing a flip, they're probably not going to lend to you because they actually lose money if they lend you money for a short period of time and then you repay them back in a couple of months on a line of credit or an open mortgage. We see this a lot for developments as well. And one of the reasons for that is that the appetite for lending for development deals does wane at certain points of the year or certain points of in the economy where major banks may actually pull back a little bit. For instance, right now in development, the pre-development permit funding is actually quite difficult to get. And so if you're not ready to break ground today, it's very difficult to get a credit union or a bank to actually give you funding today to sit on that land until you're ready to break ground. So we're finding that a lot of the private lenders are getting in while you get your permits and everything. And then once you have the DP, development permit, then you go ahead, break that private mortgage and go in with a major bank to then give you the construction financing to get you through the project. So we're seeing that more of our clients that are purchasing, holding properties for an extended period of time are going with private. First and second mortgages, we see a lot of first and second mortgages, just general situations where a client can't qualify with their bank. Second mortgages are probably probably more common than first, I would say, especially with people just needing to top up their current mortgage that they have. Maybe they have a mortgage that is a really good interest rate and they just need an extra 50 or 100 grand for an emergency or to pay off some high interest debt. We see second mortgages are quite common. And last but not least, in general, private lending is usually short term. So most of the loans that we do are short term when it comes to private lending. So I'll give you a quick idea of what a first mortgage typically looks like on the private side. Rates are generally anywhere from 4.99% up to 8.99%. Fees are usually anywhere between 2 to 3% for most first mortgages. Loan to value, that's LTV, that's usually up to 75 or 80% in most urban centers. Usually 75% is a comfort level in a major urban center like Vancouver, for instance. 80% with certain applicants can be possible, but usually pushing above 80% is quite difficult. And again, the smaller the market, then usually the loan to values start to get cut back. Certain lenders will only go to 50 or 65% loan to value in smaller centers. The payments are generally interest only. Almost every private lender does interest only payments. It makes it easier for the accounting and also easier for the borrower to afford the payments. And in general, it's closed or open. And so you can negotiate an open term on a private loan, but typically you're just paying a little bit more on the fee in order to get that. So sometimes a lender will say, hey, our fee for this deal is in total going to be 2% for the lender fee, but it's a closed term, or we'll do an open term, but the fee is going to be going up to 2.25% or 2.5% to compensate for that. So one way or another, they're going to get you, but it's something that we usually just do the math on it. If you're going to be in and out real quick, then often an open makes more sense. If you think you're going to be stuck in it for 6 or 12 months, then sometimes the close makes more sense because you'll end up paying less in interest costs, and the breakage fee would be covered by that. And in general, most private loans are 1-year term. So almost, I would say probably 98% of the private loans that we do are 1-year term. So let's go over second mortgages. Second mortgages can range quite a bit. Most of them are between 7 to 12%, I would say, or 8 to 12%. A really low loan to value second mortgage can be priced fairly cheap, but in general, you can usually starting at 2% higher than what a first mortgage would run you. I've seen some second mortgages get up to 17, 18%. Very rare that happens, but that would be a much riskier file that the lender is putting together. Fees for this are usually 2 to 5%. In general, the smaller the deal, the higher the percentage for the fees are. So if you're doing a $50,000 second mortgage, you can bank on the fees being at least 4% in most cases, just because it's the same amount of work to put together a $50,000 loan as it is to put together a $500,000 loan. And most lenders and most mortgage brokers you talk to are going to have some kind of minimum required fee to put together a transaction. Loan to value, most lenders still like to go up to 75% maximum, but on occasion, you can sometimes get a lender to go up to 85%, depending on the situation. And just like first mortgages, they're typically interest only, closed or open, negotiable, and usually on a 1-year term. So with these high interest rates, why are people using private lenders? Obviously you'd be wanting to go to banks, but the primary reason is if you've been declined by your bank. And there's a number of different reasons that you might be declined by your bank. And so then the question is, well, how do you move past that? And in what circumstances does it make sense to pay a higher interest rate to go through a private lender? I'll give you a couple of examples. Quick turnarounds. Private lenders are much faster than banks, especially in today's climate. And so quick turnarounds are something that is very important, especially if somebody's in a tricky situation. Another reason is if the deal is an amazing real estate deal and the only way to get it done because of timelines or because of qualifications is to go through a private lender. And if you're going to make $100,000 on a deal, then maybe it is justifiable to go and pay a higher interest rate on your loan. Another reason to go with private is if you're paying off higher interest or higher payment credit. In some cases, we take a look at a client situation, and although they can't qualify with a major bank to do a debt consolidation, they may qualify with a private lender. And in that case, it may make sense to replace the debt that they're paying on credit cards at 19% with a second mortgage at let's say 10%. And even though 10% sounds high, it's about half of that 19% credit card debt, right? And so it can make a lot of sense to do that. Another reason too is sometimes it's not just about the interest costs, sometimes it's about the payments. And because the private lending payments are interest only, sometimes replacing other debts with a principal and interest payment, like car loans or other things like that, loans that have a short amortization, you may actually find that you're in a much better position on a monthly payment basis by replacing that debt with private lending. Fixing credit. So another thing that we often do, let's go back to that example. If somebody has a bunch of credit sitting on their credit cards and they can't eliminate or pay it off themselves, if they do not solve the problem, and if they're maxed out on their credit cards, they will never, ever be able to actually get out of that and do a debt consolidation. So sometimes the solution is actually to come in and say, okay, I'm going to pay off your $100,000 in debt that you have, and I'm going to give you a second mortgage that you can handle. That second mortgage is not going to hurt your credit nearly the same amount as having 100 grand of all of these credit cards all maxed out or over limit. So we're going to clean things up and then give you a year to work on repairing your credit. So hopefully, if in a year your credit rating has recovered, then we can go back to the bank and get the bank to do the debt consolidation and eat up that $100,000 private loan now. So in some cases, if your credit score has taken a really big hit because of your situation, it can make sense to go in, give you a Band-Aid, let the wound heal, and then a year from now, let's rip off the Band-Aid and get you back in with the bank. Another interesting observation as well is that sometimes borrowing money from a private lender is cheaper than getting a joint venture partner on your deal. And I see this all the time with investors. So if you're buying an investment property and the only way for you to get the deal done is to actually bring in an investor to close on it, then sometimes it's an opportunity for you to sit back and look at, well, what if I came up with the money by refinancing or doing a second mortgage on another property that I own, and I'm going to pay 10% on that money. Whereas if I bring in an investor on my deal, I'm going to give away half of that deal or whatever percentage of that deal. So in some cases, you're actually better off, and the amount that you're going to give away with a private loan is actually cheaper than the amount that you'd be giving away if you had to bring in a joint venture partner and give away half of that potential profit. And the most common way, to be frank, is when people are in a bind. They've written an offer. We saw a lot of this year. We see a lot of this in certain markets where it's a seller's market. You have to go in, you have to write subject free on a property. You don't have any bank financing approvals at that time. And guess what? The financing doesn't come through, and now you're looking at alternatives. And we actually use private lending a lot for that conversation we have with our clients, where if they're writing an offer and they're just calling us and saying, hey, I found the perfect home, I want to write an offer tomorrow, and we don't have any application or files on them, we'd often say, well, look, the reality is you're not going to get a full approval from a bank if we don't even have any documents yet from you. So if you're writing an offer subject free, you have to feel comfortable knowing that your likely worst case scenario would be that a private lender would probably finance you. And these are the kind of terms that you should be okay with if you're going to write a subject free offer. So we've been dealing with that quite a bit. We have a lot of clients that call us after their bank declines them and they're already subject free on a purchase. Sometimes they just have a really tough situation come up and don't have options. So we deal with that quite a bit. And frankly, it's probably the most recent or the most likely reason that we get a call for somebody needing private money. Now, on top of that, there's a lot of flexibility working with private lenders, just like this little pup here. Private lenders are way more flexible than banks, and there's a couple of cool things that you can get creative with in order to make a deal work on private that can be more difficult or impossible with the A-lending space. And one of those is actually the opportunity or availability to do zero down. And how you do that is if you have a lot of other real estate equity that could be used as additional collateral, then sometimes we're actually able to put together a deal where you do an inter alia mortgage where the lender says, I'm going to blanket the mortgage on the new property over your other two properties that you also own. And now we have enough security where our loan to value is good. We have enough money covered, and we actually don't need to see any down payment from you. Now, we'll say this, a lot of the time the lenders still like to see that you're putting some skin in the game as opposed to just using equity in your homes. But this is a common strategy that we see, especially with situations where, let's say you're doing a construction mortgage and the lenders like to see a lot of equity up front in those types of deals. A lot of the time the question is, will your client put up their house as additional security? Will they put up additional collateral? And it gives the lenders a lot more comfort knowing that they're likely going to get paid because they're tagging not just the one property, they're tagging another property that might be more marketable. Another cool thing that you can do on the private lending side, you can set up a mortgage to have no payments. And so what you do is you can set it up where, let's say that you're borrowing $100,000 at let's say 12% interest. That's $1,000 a month. Now, what you could do is on your 1-year term, we could set up the loan to be for about $112,000. It'd actually be slightly more than that because now the interest cost on $112,000 is a bit more. But if you set it up in this manner, where you're actually putting aside the amount of the interest payments for the next 12 months, and you set it aside into the lawyer's trust account, and now the lender has their payments ready to go in that lawyer's account. And so you're not actually making payments. You're almost prepaying the lender by setting the money aside into a trust account. And this is a cool way of being able to do a loan without having any actual payments required. This is a common one that we've seen, and this is bailing people out on rent-to-owns. So rent-to-own, sometimes people get in, they do a rent-to-own, and a rent-to-own means that they have a contract to purchase a property at a future value in the future. And sometimes on those rent-to-own tenant buyers just don't have enough time, or they just are unable to improve their financial position enough so that they can qualify for that mortgage to purchase that property in 3 or 5 years or whatever the time horizon is. Now, in recent history, we've had a number of these, and in some cases, if the property value has gone up enough, sometimes we can get a private lender to just give them a mortgage for the amount that they need, the purchase price, that they have on their contract. And the reason that we can do that is that because the values have gone up enough. And so if, let's say, somebody had a contract to buy a property that they wrote an offer on 3 years ago or 5 years ago, and they're agreeing to buy it for $500,000, and let's say the value has now gone up to, let's say, $800,000, you could get a loan for, let's say, $600,000, which is 75% of the value of the property, or even 70% of the value, or whatever you need in order to get the financing and close on it. And the reason the private lender is okay is the value, the appraised value today is $800,000. And if the borrower only needs between $500,000 and $600,000 to close, then they have enough equity built into it to do that. A major bank would never do that type of loan. And in fact, some mortgage investment corporations or mixed don't do these as well. So sometimes we have to actually use an individual private investor, and we've been doing that quite a bit in the last couple of years. Construction mortgages. So construction draw schedules, they're a bit complicated. I'm actually doing a webinar in, I think it's next month's webinar, I believe, about construction mortgages. And on construction, what happens is you always have to put the value into the property, and then you get reimbursed for the value you've put into it later. And sometimes that means that it is tough. Many banks want you to put in 40% of the value before they'll give you your first draw on the property. Whereas private lenders can shorten that up a little bit and say, hey, you know what, you call us when you need money, we'll send an appraiser out, whatever the value of the property is at the time, we'll release an appropriate amount of money to you. So essentially more flexibility on how you can receive the money from a private lender. The other thing that comes up sometimes is some banks, some credit unions, et cetera, don't like to finance operating companies or holding companies. Most of the time we can get a holding company loan approved, but operating company, much more challenging. In fact, many cases, those types of deals have to go to small business or commercial lending in order to get an approval. One of the things that we find is that private lenders are way more open to this. And one of the little tricks is that if you're doing flips and you want to do it in an operating company, because an operating company is taxed at a lower tax rate than a holding company or most individuals are. The tax rate for an operating company is only about 11% tax, whereas a holding company is about 50.7%. And the average marginal tax rate for most Canadians is somewhere around the low to mid 40s. That's a main reason to say, you know what, I'm going to save money in tax by setting up an operating company and buying the properties in an operating company name. I'll pay more in finance fees, but the ability to save money in tax will outweigh that. So that's one of the reasons that we see people doing flips with private lenders. So why be a private lender? We've talked a little bit about why you would be on the borrowing side, but let's talk a little bit about standing from the perspective of an investor, which I know many of you are here to learn about it from an investment perspective and what private lending is all about. One of the important things to understand about why you would want to consider being a private lender is I want to explain the difference between debt and equity. And there's some safety around that. When you're lending money to somebody, and if that person or entity or corporation or whatever goes belly up, debt always gets paid first before equity does, always. So I'll give you an example. If you bought stock in a company and if you lent a company money and that company went bankrupt, first, they're always making sure that they try to pay off all of their creditors first, and they make adjustments on the creditors, and then whatever's left over gets paid out to the equity holders. And that's why in general, equity holders, sometimes if a company goes belly up, your stock, that stock price might drop to zero and you could walk away with nothing in that company. Whereas if you're dealing with debt, in general, those debt holders will usually get something back because they're debt holders, and debt holders get paid first. It's the same thing with a house. So if you lent money on a house, let's say that you lent $750,000 on $1 million house. If the house value drops and goes from $1 million down to 800,000, and that property is sold, well, the first thing that gets paid out is the lender, and then the owner gets paid out the remainder, whatever that number is. They don't get a certain amount out first and then pay out the debt. So just keep that in mind, that there is a safety factor here of being a lender and being able to get paid first, which is a nice feature. There are reasonable returns. Of course, there's certain investment vehicles that you can invest in that could have a higher rate of return. But there's also a lot of investment vehicles like GICs, for instance, that have a much lower rate of return. Getting between 6 and 12% on your money by investing in private mortgages is a pretty decent return. Another thing that's important to understand too is it's just easier than buying real estate. The reality is getting a mortgage sucks. I'm a mortgage broker, and getting a mortgage is not fun. That's the reality of the situation. I like the returns of owning real estate because of the cash flow, mortgage pay down, and appreciation. But buying real estate is a lot more work, frankly. And Ian mentioned GICs is actually a negative return. Yeah, because if you inflation adjusted, GICs are actually losing you money because it doesn't even keep up with inflation, right? So either way, it is much more difficult to obtain real estate and more onerous, especially if you're retired or whatnot. And so we find that for the ease of investing into this investment vehicle, a lot of people are considering private lending. It's also a little bit more liquid than owning real estate in general. It's especially depending on what you lend on, and especially if you invest in mix or other things. If you lend out your money and you have a 1-year term, and at that 1-year term you decide, you know what, I'd like my money back. Well, it's up to that person now to repay you those funds after that 1 year. One other item I'd like to mention too is better cash flow. At the end of the day, if you look at investing your cash and purchasing real estate, if you put 20% down on a property in today's market, in today's climate, you're probably not cash flowing positive in most areas of Canada. In some areas you would be, but in most areas you would not be. And if you took this the same cash and invested it into private lending, you would actually have a higher cash return. But keep in mind, the cash flow is higher, but you're not getting any mortgage pay down or appreciation. There's no other return that you're getting. And so it's a little bit more heavily skewed towards cash flow. Overall, what I observe is that you'll find that a lot of people move into this type of asset class as they start to reach retirement, or once they feel like they have enough money in real estate itself. So it is a way of diversifying and saying, hey, I own a lot of real estate. Maybe I should own the debt on the real estate too, if you're a firm believer that you really like to have your assets in real estate. Instead of just owning only real estate, maybe you own some real estate assets and some debt assets in real estate. Another thing is that retirees often move into this because it's harder to qualify once you're retired because you have a lower income to purchase real estate. And so the ability to say, hey, you know what, now I've amassed this amount of cash and I'd like to just make it work for me and invest it. And you'd like to replace your income that you just lost or what dropped because you're now retired. You'll find that more people start to move into the cash flow side. There's just less risk, less volatility, and not as difficult to qualify to do this because there are no qualifications really. So how do we properly assess the risk when we're looking at what type of property should we lend on? And the reality is private lending underwriting is very different than A lending and B lending. It's almost completely flip-flopped. So let me just go through a quick snapshot for you guys. When you're dealing with private lending, the bulk of the underwriting and the bulk of the assessment is the property location, the type of property, and the loan to value. Ultimately, at the end of the day, what the lenders are looking for is a highly marketable property in a market that has a lot of buyers. And so this is where if you buy something that's very unique, anything that can be considered unique or have a undesirable, any marketability concerns is something that the lenders are going to think, maybe I don't want to lend on this property. As an example, I heard that there is a bit of a loophole with ALR land, and many private lenders are hesitant to lend on ALR land, so are B lenders. Because on ALR land, there may be a loophole where if you stick 6 chickens, and I'm not joking, the story apparently is that if you stick 6 chickens or more on your property, now you have farm status. And now all of a sudden they cannot foreclose on you without going through a much more onerous process. And so, of course, from a lender's perspective, well, if I want to know that I can get my money back, then I don't want to lend on a property where if a guy sticks 6 chickens on it, I can't get my money back, right? So there's certain things like that are concern for the lender, but in general, it's major urban centers and cookie cutter, easy to do, easy to sell properties with lots of buyers. Condos, detached homes, that kind of stuff in Vancouver, Toronto, those are the easiest types of assets to lend on because they're very liquid. The next thing up is the exit strategy. And that's almost always I find when I have new brokers that work for my franchise or under my brand, my team, that's probably one of the things that gets missed when you're selling a deal to a private lender is what is the exit strategy? Because the private lender wants to know, like, hey, you shouldn't be on the never, never plan. You should be ensuring that you have the ability and you have a plan to pay us out. So what is that plan? How do you plan on getting rid of this high interest mortgage that's potentially going to bury you if you can't get out of it? And so the exit strategy is a very important thing. And as a borrower, you probably also want to have an exit strategy to get out of that 6, 7, 8% interest rate and get into a low interest rate. Sometimes it's not possible, but the key is to be able to show and exemplify, hey, look, I need this private money for X period of time, and here's my game plan, and positioning it and selling it as much as possible to show that you're going to be in and out quickly. And then at the very top of this pyramid, and the smallest piece, is actually the borrower and what the borrower's qualifications are, what their circumstances are. Because at the end of the day, the borrower might have poor credit, but it might be very explainable. They might have a low income, but it might be very explainable. If you're lending on a solid property with a reasonable exit strategy, even if the borrower isn't A+, you can generally get private lending on it. So that's generally how things break down on the private lending side. And here's the key fundamental difference. And we've talked a little bit about property, but from an even higher level, when you're dealing with a bank, they try to eliminate the risk of default as much as possible during the underwriting process. So they have an in-depth underwriting, and it's much slower. So that's where the banks are really trying to dig into and figure out, like, what is going on here? Do we think that this borrower is a solid borrower? Do they check out? Do they tick the boxes? On the private lending side, instead of eliminating the risk of default, a private lender actually just assumes that default will happen. And so they just say, well, what happens if we are going to foreclose on this property? Will we get our money back? And the property is the primary concern whenever you're dealing with underwriting and risk assessment on a private lending deal. And they're much faster because of that, because they're just really looking at the property. They don't have to dig through a bunch of supporting documents to review the borrower as well. One interesting way of looking at private lending, if you're coming from the private lender's perspective, is if you're lending 75% of the value of a home, the question is, would you buy that property for 75 cents on the dollar today? So if it's $1 million home and you're lending $750,000, the reality is, if this borrower goes belly up and the value drops or whatever happens, and you don't get your money back, you put 750 grand into this property, would you buy this home for 750 grand? Would you own this yourself? And that's where you find a lot of the time private lenders often are previous specialists. So I have a couple of private lenders that I work with that used to be in construction. And so they understand construction, they know everything. And if things hit the fan, they can jump in there and solve the problem and recoup their capital. Some investors look at it and say, you know what, I really like multifamily, and if I had to buy this multifamily building for 80 cents on the dollar, I would do it. And so therefore we find that there might be a higher appetite for higher loan to values in certain assets with the right lender. So this is something that can come up a little bit, and just something to keep in mind. So I want to give you a quick, this is one example, and then I'll go through a couple of other examples of deals that we've done, and some broad stroke ideas of different types of deals that can be done too. This one was kind of an interesting one. I mentioned about rent-to-own situations. And so we actually had a borrower, a tenant buyer that couldn't close on the rent-to-own. And because most mortgage investment corporations, so the institutional private lenders, often have specific rules or guidelines. And it's just because of the way they operate. It's actually quite difficult to get lending for this borrower, even though we're only borrowing about 67% of the value of the property. We actually put this deal together and presented it to an investor. The interest rate was 9%, and the lender fee was quite high because nobody else would do it. And the lender fee is 3.5%, and this is for a 1-year term. And after the 1 year came up, the borrower still could not pay off the loan, and we found a new lender to replace this lender and pay off our investor. Our investor walked away after that with a 1-year return of 12.5%, and they only lent on up to 67% of the value of the property. And I think it was out in a house in Surrey, if I'm not mistaken. So a reasonably low risk deal. I would say that the borrowers were perhaps not the most astute, which means that the fee was a little bit higher for that, because I had a feeling there might be a little bit more work involved on that particular transaction. But long story short, the investor made a pretty good return on that deal. So let's go through some examples. First mortgages, there's lots of different examples here, but bridge financing is a common one for self-employed borrowers, retirees, and many others. Very recently, we did a $600,000 loan at 65% loan to value at a 7% rate and a 1% lender fee. We've actually done a few deals even more recently where the rates are even lower than that, about 5.49% for 65% financing, depending on the situation and where the deal is. Second mortgages, we do a lot for debt consolidation, paying off CRA debts, business loans, and many other reasons to get a second mortgage. Recently, we did a $150,000 loan. It was 58% loan to value, and the rate was 10%, and the lender fee was 2%. And short-term loans. So this would be what I call hard money. Much riskier. It's unsecured. A lot of the time, these are for businesses, renovations. These are for flips, JVs. Sometimes these would be put into the deposit loan category. Sometimes the term hard money can actually mean two different things, and I see this the term be interchangeable. And in my own mind, and maybe this is what other people's minds think the same way or not, but in my mind, hard money means unsecured money. It means it actually does not get registered on title. And I actually do execute some of these short-term loans myself on deposit loans and other types of loans, where we have the right to register it as a mortgage, but because the fees for registering a loan on title, because you have to have the lender's lawyers and the borrower has their own lawyer as well, the cost can be $3,000 or $4,000. And for a micro loan of $15,000 or $20,000, the legal fees alone could end up being 25% of the actual amount that they're getting. So sometimes we do short-term hard money loans. And very recently we did a hard money loan for $20,000 with a 25% interest rate and a 2% fee. I find often the types of loans that we do for short-term money loans like this, often the fee is usually higher, and then the rate doesn't kick in unless the loan is paid out in past 30 or 60 days. Especially for deposit loans, we usually say, hey, as long as you pay us out when your house sells, then there's no interest rate, but the fee is $1,000 or $2,000 to borrow $15,000 or $20,000. So this is deposit loans. So if the buyer's equity is stuck in their home for sale, short term, maybe 6 to 12 weeks. And in general, we charge about $1,000 per $15,000 lent out. There's, it's not specific math on that or anything like that, but that's what we've done in the past. There was an interesting deal I did a couple of years ago. It was a $60,000 deposit loan. And the borrower did not want to owe the money. And she insisted, no, I just really want to pay the investor back. She ended up getting the money from her grandmother or something like that later on. Because it was very difficult to find an investor that would do the deal, the investor charged $5,000 to lend $60,000 for 2.5 weeks. It's a pretty good annual return on investment, I must say. Flips, so it's obviously hard to get bank financing on flips. Operating company is something that's very difficult to do unless you're working with commercial lenders. And on flips, again, the rate is not as important. We did a small flip loan at 65% loan to value at 7.95% with a 2% fee, and that property was in pretty rough shape. So that's why the interest rate is a little bit higher. And then development. Bank financing is quite tight right now. Private lenders can be more flexible, and it's good for lenders who are ex-builders and developers, as I've kind of alluded to a little bit earlier. If you're familiar with it, then it gives you some comfort knowing that if you had to, you can take the project all the way through. We had a deal that was $1 million loan. It was only 50% loan to value because it was a land loan, and that was at 9% interest with a 1% lender fee and a 1% broker fee. So different deals, different circumstances. Now, ultimately, if you don't want to do the work of reviewing these files, and I'll get to a slide a little bit later that shows that we do some of the work for you if we're placing your funds for you on private loans. But if you'd rather not have to do the work and review and on a one-off basis determine if you want to lend on that deal or this deal, you can also just invest in a MIC, a mortgage investment corporation. So a good friend of mine, Justin Smith, actually put this deal or this little slide together for me. This is what he does actually, and it talks about how the mortgage funds move around. So if you look at the people on the left-hand side, they lend money to the institution, the MIC, then papers deals and analyzes and underwrites, and then lends out that money in multiple properties and multiple borrowers. Those multiple borrowers then pay that money back plus interest back to the institution, which then pays out the investors a return. Now, what a MIC does is a MIC lends out the money probably at 8%, and they take anywhere from a 1 to 2% cut off the top, and then they pay out the investors the remainder. And that 1 to 2% is basically their servicing fee for being the middleman. But it's a way of you getting involved in a couple of different ways. And one way that you can envision this is that you could be a small part of a really big deal by getting into a MIC, because a MIC can pool a lot of funds and resources together to then lend on one project. And so you can get into real estate investment-backed assets without a lot of effort by just planting your money there and letting people place it for you, and they would generally have standard terms and agreements that would stand out for you. The other reason that you would look at a MIC is that your funds are well diversified. So if one property goes belly up in that MIC's portfolio, your funds are not really at risk because they might have 1,000 mortgages out right now. So it's a very minimal impact on the bottom line. Whereas if you're an individual private lender and you lend money on one deal and that deal goes belly up, well, all of your money that you've lent on that is at risk, right? So it's just a matter of trying to figure out what the comfort level is and also look at, what are the expected returns in each and figuring out which route you prefer. So the question often is like, how do you choose? Do you want to get into private lending? Do you want to do a MIC? Just park your money into a MIC and let it ride. I also wanted to look at, well, what about purchasing real estate, or what about investing in stocks? So I'll go through a little bit of the difference here. But number one is qualifications. If you're looking at qualifying in purchasing real estate, you definitely have to qualify for that. Private lending, you're not qualifying. For a MIC, you're not qualifying, and for stocks, you don't have to qualify for anything. So really, qualifications here, not in real estate's favor. Everything else, you don't need to qualify for debt or anything. Now, this is where things get a little bit more skewed, because if you're purchasing real estate, the average total return on investment can be between 20 and 30%. It really depends on the type of transaction that you're investing in, but in general, purchasing real estate will end up being a higher overall return for you than investing in private lending, a MIC, or stocks. And that's because you make money in three ways: the mortgage pay down, appreciation, and the cash flow. And in general, and I've mentioned this a couple of times in previous slides, but it's the power of leverage really that gives you that ability to make that kind of return in real estate and owning the real estate. And that option is not available in private lending or mix because you are the lender. And in stocks, there are some options, but it gets a little bit more complicated with margins and options and things like that. The returns in private lending are often 6 to 12%. In mix, probably 6 to 8%. They have a tighter bandwidth in general. In private lending, of course, you have the option of doing really low risk deals or much higher risk deals. In general, most of the clients in our office that do private lending, we usually don't do the really high risk stuff. I prefer not to do that type of lending with our own investors. We usually try to do it out of our bounds, out of our office. That way, we're not representing both the borrower and the lender. And if that transaction goes sideways, I'd rather not be representing both sides. If we have a deal that's quite difficult to do, we'd typically rather go to a third-party lender. And if that third-party lender decides to lend to us and we didn't represent them, then there's a little less risk for us to be the middleman representing both parties. And the stocks, it's hard to say, of course. If you've been investing in stocks in the last couple of months, this number might be very different. Yeah, if you invested, last year between March and December, then you probably did pretty well. So stocks can vary quite a bit, but on average, usually stocks are the returns are between 5 to 10% per year. Cash flow. This is where it can vary a bit. Cash flow and investing in real estate, usually only about 1 to 4% return per year. Private lending, 6 to 12, MIC, 6 to 8%, and stocks, if you're investing into dividend stocks, then maybe 3% to 6%. But again, that's only if you're investing into dividend stocks. Most stocks are, of course, not dividend producing stocks. And so typically you wouldn't get that kind of cash flow from investing in stocks. So the obvious observation here is that private lending and mix do have the best cash flow out of all the investment opportunities on the board here. Term of investment, generally speaking, in purchasing real estate, it should be viewed as a 5+ year type of investment or term. Not always, but in general, it should be viewed as such. Private lending, usually 1 year commitment. Of course, you can negotiate smaller, you can negotiate longer, but generally speaking, it's a 1 year commitment. Investing in a MIC, a bit harder to say, but a lot of the MICs will have specific restrictions from you being able to pull out your funds within a short period of time. So you need to check. Every single MIC has a different different agreement that you'd have to review. But one of the things you want to look at is how easy is it for you to pull out your money, and how long of a term are you investing in? And stocks, 1 minute to 1 lifetime. It really varies quite a bit. In fact, I should put 1 second to 1 lifetime because the speed at which things can happen on the stock market. So payout frequency on purchasing real estate, it's a little bit different here. In general, you're receiving payouts on a monthly basis from the cash flow, and then the rest of it is all upon the refinance or the sale of the asset. So your payment frequency, you have a couple of different ones there. With private lending, it really depends. But most private lending deals, you're getting paid out on a monthly basis. Sometimes in certain cases, it might be quarterly or annually, but in most private lending deals, it's usually monthly. A MIC, this really depends. Most MICs pay out quarterly or annually. A few of them will pay out monthly, but most of them pay out quarterly or annually. And then stocks, if you're owning dividend stocks, then it's usually once per quarter, but otherwise the payout is when you sell it. Volatility and risk. I would say that the volatility and risk in owning real estate is probably medium, and that's because real estate values can go up and can go down. In private lending, it's fairly low to medium, but it depends on the type of investing that you're doing. Of course, if you're doing low risk lending, if you're doing high risk lending, then the risk might be higher than that. With a MIC, it's fairly low because your money is spread out amongst a number of different properties, and so the risk of you losing your money and investing in a MIC is very, very low. And the volatility and risk in stocks is, of course, very high. Again, it depends on what kind of stocks you're investing in, but in general, stocks have way more volatility than any of these other investment opportunities. On the flip side, the liquidity for owning real estate is quite low. Private lending would be a medium because on an annual basis, you decide not to renew that mortgage. MIC, also medium, because there are some restrictions. Sometimes you can pull it out if you give them a certain amount of notice, or you can pull it out every quarter or whatever. And then stocks, of course, very liquid. You can sell your stocks very quickly and get your money easily. RRSP eligible. So this is an important question. When you're purchasing real estate, in general, unless you get really creative with things, you cannot use your RRSPs to purchase an investment property. If you're a first-time home buyer, however, you can pull it up to $35,000 out of your RRSPs towards your first purchase of your house, as long as you repay it back over 15 years. Private lending, though, it is RRSP eligible, and I'll explain that in a couple of slides how you can do that. A MIC, usually they're RRSP eligible, and stocks, usually they're RRSP eligible, unless you're investing in certain stocks that are not allowed to be purchased using registered investments, which is pretty rare. I think I remember trying to buy, can't remember what stock it was, but it was a couple of years ago. I was trying to purchase some stocks that were considered higher risk, and Q-Trade wouldn't let me. But it's pretty rare that you can't invest in stocks using your RRSPs. So hopefully this gives you a kind of a brief overview of the difference between investing in these different classes at a glance. So after we've looked at the different opportunities and different ways of doing it, how do you get started? How do you invest in become a private lender? The first thing that we always look at is where's your cash going to come from? And if you don't have a lot of cash, then usually looking at your home equity is a great opportunity, a great place to look at that. The reality is, a home being paid off is not really working for you, because other than the appreciation, there is no gain. And so we talk a lot about something called the Smith maneuver here in our office. We have a couple of our agents that are Smith maneuver certified, which means that they've gone through a course and whatnot to learn all the nitty-gritty details. And of course, I've been educating clients for probably almost 15 years on the benefits of borrowing money against your home, and being able to write off the interest portion of the payments. But what people do often is they'll get a HELOC, a home equity line of credit. So in this case, let's say that the value of your home is $500,000. You can get up to 80% of the property value available to you, so you can use that to invest. And so in this case, if your mortgage was $225,000, then you can get a line of credit for $175,000, because the combined amounts equal $400,000, which is 80% of the property value. And what you do is you work on paying down your mortgage, which then goes over to your line of credit, and then your line of credit limit goes up, because in this situation, your combined amount of credit you have access to would be $400,000. So if you pay down your mortgage from $225,000 to $200,000, your line of credit would go up from $175,000 to $200,000, because the combined amounts can be equal to $400,000. And then what you do is you take that money available in your line of credit, and then you're reborrowing that money back out to invest. In fact, we've had situations where clients have cash that they want to use to invest and be a private lender or do whatever with. And we advise them that, hey, if you took the cash, paid down your non-tax deductible personal mortgage, and then reborrowed the funds back out, you'll create a tax deduction on that cash that you were about to use. And now you're able to create it, lower your taxable income on your tax returns on an annual basis moving forward. So if you ever want to learn about tax, our office is extremely adept at not tax advice, because we're not accountants, but we're very good at understanding how the tax works and pointing you in the right direction and getting you to ask the right questions of your accountant to ensure that that you're maximizing your tax savings as much as possible. So what a lot of our clients do is they get a home equity line of credit set up, and then they just create a spread, and they create a spread on the amount of equity that they have available to them. So if you borrow your money in your line of credit at 2.95%, and then invest it at 8%, you're creating a spread of 5.05% of your money. So if you borrowed $100,000 that you get access to, and you wouldn't have had it before, if you just took the 100 grand, borrowed against it for 2.95%, invested at 8%, you would make $5,000 on money that you didn't even have. If then on $200,000, you'd make $10,000 a year on money you didn't even have. As long as you're creating a positive spread between the cost of borrowing and the return on the investment. And what you'll find is that in general, private lending rates and whatnot will move around a little bit based off of the current interest rates in the marketplace. Private lending rates used to be higher than they are today. Private lending rates at below 5% is pretty much unheard of. A lot of you here have probably had mortgage rates over 5%. I know my first mortgage was at close to 6%. So interest rates have been higher in the past for sure. And the reality is that that spread of about 5% will probably stay around no matter what. Prime rate might go up a percentage or two, but it's likely that the cost of borrowing on the private lending side will also go up, which means your spread would probably still remain the same. So mobilizing your funds, if you don't want to use your line of credit, no problem. You can also use RSPs, and what you typically have to do is you usually need to self-direct these funds through Olympia Trust or Canadian Western Trust in order to be able to lend your money out. So you have to self-direct it, and there is a fee. I believe it's $200 and something per year to self-direct your RSPs. It's not that expensive, but you do have to self-direct it through Olympia Trust or Canadian Western Trust in order to get the funds out the door. You can always use cash, of course, no problem using cash. And believe it or not, you can even use the TFSA. I find that it's uncommon that people use the TFSA to do private lending because the amount in most people's TFSAs just aren't significant enough to be able to do most private lending. As I mentioned before, most private loans are over $50,000. Like the vast majority of them. It's very rare that an individual needs $30,000 or so. And it would make financial sense to go with a private lending lender because, again, those legal fees could be $4,000, and borrowing $30,000 and paying $4,000 is just a very expensive cost. So normally people would go to unsecured lending to get access to the capital that they need. So you've got your money mobilized. Now you want to figure out where do you deploy it. If you are working with our team to place the funds, then typically Amy in my office would send you over a private financing lender sign up. And this is where you actually select the type of lending that you'd like to do. And it'll give you an idea of what your approximate rate of return would be for the investing into those types of mortgages. So you can go really wide with it if you wanted to and say, yeah, I'd like to see everything. You can also go very narrow with it and just see a very small section of potential deals. And that really is up to you and your risk tolerance. And then when we do find a deal that looks interesting, then we prepare a one-page summary sheet, send it over to our client along with the appraisal, and our investor makes a decision on whether they'd like to lend on that deal or not. So it's time to get your retirement strategy in place. You can always come to our go to our website and learn more. We have a ton of different information online. We have an investor survival guide. We have a private lending package that you can download from our website. My upcoming webinars, I have 3 more coming up this year. It's always the first Wednesday of every month. Construction lending is coming up October 6th. Commercial lending is coming up November 3rd. And then financing your renovations is coming up December 1st. If you have any questions, feel free to book a consult with our team today. For those of you that don't know, I also have a book called Rockstar Real Estate Investing that was an Amazon bestseller. And any of you that do not have a copy of this book, I'm happy to send a copy in the mail to the first 5 people to send an email to our team. Our email address is info@greenmortgageteam.ca. And I always like to open up for Q&A at the very end of these. And I'm happy to hang around until most questions are answered. So that concludes the presentation, and I'll start to get to the Q&A and start to answer some questions now. Okay. Let's get to the Q&A. Where did the Q&A go? There it is. Okay. So we have a question from Selena. So with a B lender, you can get up to 80% loan to value. So that is possible. Some B lenders in certain markets will not go past certain loan to values, or in certain property types, they will not go past a certain loan to value. So for instance, a lot of B lenders, if it's a condo, they'll reduce the loan to value from 80 to 75. And some of these, if it's a rental, they'll reduce it from 75 to 70. So some of these they'll chip away 5% off if it's a rental and if it's a condo. But 80% is still doable. For strong clients, we're able to get 80% financing even on rentals that are condos. How does private lending work on U.S. properties? So it's very similar down in the U.S. There's a lot of private lenders that lend down in the U.S. And so private lending in the U.S. is very similar to Canada. There's not a lot of differences, frankly, between U.S. and Canada, from my understanding. I'm sure there's a couple of minor nuances, but for the most part, private lending is pretty similar. Loan to values are pretty similar. Like everything, the U.S. often is a bit more aggressive with things, and there's more funding sources. And so I find that the funding might be a little bit more aggressive than what we see in Canada, but fairly similar. I have a question from Doris. So in your example, is it interest only or amortized to pay back on the 1 year term? So it's interest only, and the term is 1 year. So that means that after the term is up, then the same amount of the original principal balance is due again. And that can be either renewed if the buyer or the borrower and lender agree, or it can be the lender can request to be repaid back, and then that borrower needs to find a way of paying that lender back. Peter asked a good question. So what happens when people default in a private lending case? What are the procedures? So you have to engage a lawyer, and you actually have to start to send the borrower notifications that they're behind on their mortgage payments. You have to be 90 days behind on your payments before you can initiate a foreclosure process, which can delay things. And then and it's probably another 9 months or so of going through that foreclosure process before you're able to execute what I believe is a order nisi, I believe is the terminology for it, which basically gives you the right to force a sale on the property. So it can take a bit of time. In most cases, it's best to work directly with the borrower and find a solution to the problem if possible. But in general, as soon as you get a situation where the borrower might not be paying you, then it's wise to engage a lawyer. There's a couple of lawyers here that do a lot of foreclosure work, and so if anybody runs into that problem, then we introduce them to the lawyer right away. Luckily for us, we haven't actually gotten into that situation. We've had, of course, a couple of clients that were unable to pay their payments at certain periods of time, but we've never had a situation hit foreclosure yet. Jennifer, excellent presentation. Thank you. I especially enjoyed the explanation about the safety of private lending. The debt gets paid back first. Thanks for that. Thanks for that, Jennifer. Yeah, it's an observation that I think a lot of people don't understand or realize, that when things go sour, debt holders get paid first. Jay asks, do I do both private lending and mix? So I have connections with a few individuals that can help you, introduce you to mix. Mix, there's a bit of a change with how mortgage investment corporations have to be run. They actually have to fall under what's called an exempt market dealer, and they need an individual to raise capital for them has to have an exempt market dealer license, and so you have to go through an exempt market dealer in order to invest in a MIC. I have contacts for that. One of my good friends, he actually went through, and I think he interviewed 70 MICs over a 18-month period to find the MIC that he liked the most. And so I'd be more than happy to share that contact information. Jay, if you just send us an email at info@greenmortgageteam.ca. And that goes for everybody. I'm happy to do an introduction and connect you with somebody that could help you with that. Peter asks, you charge an administration fee to set up a private lending deal, a fee off the top similar to a mix. So the difference is when we charge a fee, if we're doing the private loan, any fees that are charged are actually charged to the borrower. So it's a little bit different. We are charging our broker fee on the top, and that gets added to the interest rate or added to the broker fee. So any fees that we charge, the borrower is paying us, whereas with the MIC, typically the MIC is lending out money, and then off of the MIC's fees, that gets kicked back. So in general, investing with a MIC, usually it would result in a slightly lower overall return for the borrower, but it's also less work. So it kind of depends on the investor and what their preference is. Leslie has a question. Do you have criteria to pick a person as a private lender? So the reality of what happens, Leslie, is we have a stable of private lenders that we work with. Some private lenders are more responsive than others. Some private lenders are more likely to do a deal than others. And the reality is, if we package up a deal and we send it to a private lender, we don't want to spray it out to 10 different private lenders and whoever gets to us first wins, right? But at the same time too, most people that are looking for private money need it quick. They need it really, really fast. They need it yesterday. So it's a kind of a fine balance. We try to send it over to our private lenders, and if our private lender is really slow to get back to us, always says no, etc., then it's less likely that we're going to go back to that person over and over and over again, knowing that it's unlikely to be a success. So in general, any mortgage broker is going to be going for the path of least resistance in these situations. And so you'll find that if you're somebody that says yes or no quickly, then it's more likely that you'll be able to see more deals. And so that would be our criteria for instance. But also that sheet that we ask our private lenders to fill out, it allows us to funnel down the type of deal that we think is ideal for you, because I don't want to waste your time or our time sending you a deal that's way too rich for how much money you have, or vice versa, where it's a small $50,000 loan, it's not worth your time, and you have $5 million that you'd like to place. So we try to make sure that we find the appropriate home for everybody. Peter asks, how do we deal with defaults? Additional costs to chase back the funds? Yes. So there are provisions inside of the loan agreement that charge for NSF fees, and so there are additional charges that get involved in that. We, as the broker, if we place the file, then we work with the lender and borrower to ensure that payment is made, and that is partially our responsibility. Now, ultimately, at the end of the day, if the borrower does not pay, there's certain limitations to what we can do, but we have had situations where the borrower doesn't pay. I pick up the phone, say, hey, what's going on? You know, the lender said that your last check bounced. Can you let me know what's going on? I understand things are happening in your life. Let's find a solution. And in general, when you act in that manner, you're more likely to get repaid instead of the client trying to stiff you. Thomas asks, is there generally a minimum amount to get started lending? Not necessarily, but in general, the smaller the amount that you have, the less deals that come in that will actually be a match for you, right? So if you have $50,000, well, you're only going to get to see your $50,000 or smaller deals, which just is a smaller subset than if you had $1 million to invest. Well, anything $1 million down to 50,000 would hit your radar. So there's not really a minimum. Mix will often have some kind of minimum that really depends on the mix. Most of them probably $25,000 to $50,000 would be a minimum. Some might have a minimum as high as 100,000. Sarbjot asks, how much can foreclosures cost in Alberta? Well, 20% cover for it. So the reason that most lenders go to 75% loan to value is that in most cases, you will probably be covered off if a default situation occurs and you have to foreclose on the home. At 80%, it's a little bit more of a 50-50 situation where you recoup all of your money or not. And so that's why private lenders usually make sure they're 75 or 80% in most cases, unless it's a really strong deal with a strong exit strategy. Alberta foreclosures aren't significantly different than BC, other than the fact that perhaps the market does seem to be a little bit more volatile in Alberta than it is in most areas of British Columbia, which means that you may not be as inclined to go to a high loan to value in Alberta as you would be in BC. And that is just coming back to the overall, what are the most and least risky markets to invest in, and major urban centers that are very safe and very stable are typically the places that private lenders like to place their money in. Is there any etiquette to know when lending investor to investor? That's a good question. Etiquette, what would I say is important? I mean, I would suggest that if you're getting to know somebody, you're looking at investing or lending somebody money, I think you just need to make sure that they understand that this is a business transaction and that you're doing your due diligence and you'll go through it. I've been on both ends of the fence where I've done private lending out the door. I've borrowed private lending personally. I've borrowed money to put together joint venture partnerships. I've lent money out to friends and family. I've kind of been in that money business. And I think in any situation, you just have to be very very straight with people and tell them exactly what's going to happen, and that you're going to treat them just like you would treat anybody else. The same due diligence, the same type of security would be required, and you just have to be in a situation where You do up your agreements, just like if you're doing a joint venture, you should do a joint venture agreement. Same thing with the lending agreement. You should have all the provisions in there that say what happens if this deal goes sideways, so that there's no mistakes or questions later. Rajat, how are you doing? Can we not use RSP TFSA to get equity in real estate lending to arm's length investors? So yes, and that's kind of what I alluded to, that technically you can't really use RSPs in a direct way to invest in real estate, but you can if you're lending it to an arm's length real estate investor that then lends it back to you. But the problem then is they have to, it's still registered as a mortgage and it has to get registered as a mortgage on your property. So it gets a little bit more complicated than that. But the simple answer is that it's rather difficult to do that, and most people don't go through the hassle of it. Usually they just invest their RSPs into something else. Helen asks, is there risk to get principal back from MIC? How to mitigate this? There of course is always risk in any investment. Sometimes what you often want to read is what restrictions you may have with getting your money back. And there have been periods of time. The most recent two examples were COVID. Actually, many MICs froze redemptions in their MICs, and the subprime crisis was another example. But what happens is if they allow everybody to pull out, then it can actually create a huge downward spiral that then just really punishes the people that didn't pull out immediately or right away. And so they often put protections in there where they are allowed to freeze redemptions for a certain period of time. And the reality is almost no MIC, most MICs still make money even during COVID, even during the subprime crisis. Most MICs were still quite safe. But it really comes down to checking what the parameters are for each MIC, because most of them do have some kind of ability to freeze redemptions. So you'd have to be considerate of that. Question if this talk is recorded. Yes, it will be, and actually everybody will be emailed. So all attendees will be sent an email recording of the presentation once the recording is done. And David asked, will be recorded? Yep. So we will, we'll be sending out a recording for sure. And Sarvjot asked, so if the loan to value is 80%, you're referring to a foreclosure in Alberta. 80% is probably pushing it. I would say most private lenders are not doing 80% in Edmonton and Calgary right now. It's possible, but for the most part, most of them are not doing 80%. Most of them are doing 75% max. Lily asks, when people become private lenders, does the cash usually come from a corporation or an individual? So that's a good question. It really depends on the individual. We've done it both ways. It depends on whether you have cash sitting in your company name or if it's coming from your personal account. It doesn't really make a huge difference. There are obviously some tax implications depending on what's going on, but it really depends, and it's completely up to you. And what I will say is most people do not set up a new corporation to do the lending. They usually will just use a corporation that is holding retained earnings or cash sitting in it, and that could be the lender, or it could be themselves personally. In general, what I find is that if you're lending the money, you don't have to be as worried about having your name out there. If you're borrowing the money, then sometimes it's nice to have an additional layer of liability protection by doing it through a corporate entity. But in most cases, it's pretty uncommon. We don't see a lot of it. I see even some of the larger private lenders are still just doing it through a personal name, but it really depends on the situation. Al Noor is asking if you're interested in MIC lending, can you do that through our office? So we're not a registered MIC, so we do not administer MIC funds. I have a number of different MICs that we work with, though, and I'm happy to make introductions. If you're interested in investing in a MIC, just email us, and we're more than happy to do an introduction. Jason has a question: how's the payout breakdown for you and the investor on a private lending deal? So typically, as the mortgage broker on a private lending deal, we usually charge a broker fee, and that's usually 1% of the loan amount, give or take. And then usually 1% of the interest rate we add that to the loan, and the borrower is paying that 1%, but that 1% comes to us. So, for instance, if we look at a deal and we think that the fair rate for the borrower is a 7% interest rate, then we'll usually say, okay, it's going to be a 7% interest rate plus our 1%, so an 8% interest rate in total. And then a 1% lender fee goes to the lender, and then a 1% broker fee goes to us. So in total, we may make up to 2% on that loan, 1% on the broker fee, and then 1% on the interest rate itself. That would be an example of what we typically do. And again, usually we're looking at charging fair market for that loan, but we usually add our 1% for doing the administration. Okay, so another question. Would it be worth getting into private lending with 50 or 60 grand to get feet wet, or would the return be better in a MIC considering legal fees, appraisals, etc. in private lending? So one nice thing about becoming a private lender is the borrower pays all of the fees. So you don't have to worry about any of the fees. They pay for your lawyer to register your mortgage and title. The borrower is paying for the appraisal. All of that is all covered by the borrower, so you don't have to worry about that. The question really becomes, a MIC is a lower risk investment for you, but it's probably going to be slightly lower return. Kind of depends on what your comfort level is with that. But 50 or 60 grand, you might be better off doing a MIC just because there's not going to be a ton of options for you. You're not going to have a lot of $50,000 deals hitting your desk that need to be funded. So you might be sitting in your 50 or 60 grand for a while until the right deal comes across your desk. Selena asked, do you see a lot of foreclosures on your deals? No, I don't. My client base is a little bit different though than most client bases. My average mortgage, my average client is, I think they have a 760 credit score. My 80% of my clients are real estate investors. And so in general, my clients and my borrowers are a bit more sophisticated than your standard mortgage broker. And so I do deal with a higher quality of applicant. But on the flip side, what my applicants are doing can be considered from the bank's perspective as higher risk. So I have clients that have 7 rental properties that can't get financing through a bank. Well, that could be something that falls into the private lending side. And I've actually found that over time, a higher quality of borrowers now borrowing money on the private lending side than what I've seen in the past, because the major banks are tightening up, which means those borrowers are now having to go to B lending or private lending. But the answer is no for foreclosures. I've actually have not had one foreclosure on any one of my deals that I've had. They've always been worked out in the end. I've had a couple, I think 1 or 2 that got kind of close, but nothing that actually went to foreclosure. What sort of checks should a private lender do to reduce the lender risk? Good question. So in general, you're pulling title on the property. An appraisal is an absolute must. Some private lenders like to go and view and walk around the property, or at least Google Maps. Google Maps is a great way of getting an idea of the location. You might have an appraisal and it might not really mention that it's right next to an industrial area, or it's in a really bad neighborhood or whatever. So sometimes people like to walk the area, drive by the area, or even just use Google Maps to check it out. If you want, and then from there, really it comes down to understanding the exit strategy, and understanding, would I own that asset for X cents on the dollar? Basically, however much money you're investing in the deal, you know, if it's 75% loan to value, would you own it for 75 cents on the dollar? Another thing that you would want to do is consider how much income documentation and how much verification you want from the borrower. But I will say this again, you're competing versus other private lenders that are not going to ask for that. And if you start asking for a bunch of documents, the broker or whoever's in the middle or the client might say, you know what, I'm going to go to the path of least resistance because this lender is asking for no documents. You know, there's some private lenders that we send deals to, and their system automatically gives us an approval within an hour or two. And it just says subject to satisfactory appraisal. That's basically it. So it's something you need to consider, is that you can, of course, do a lot of checks if you want to, but you might lose the deal because you're diving into it too much. So most of the work ends up being more property related and less client related. Michael, my email address is kyle@greenmortgageteam.ca, and the office line is 604-229-5515. And Dan, yes, the presentation will be available to view at a later date. Michael asks, which MIC do I use? We actually fund mortgages through a lot of different MICs. There's a few of them. Neighborhood Holdings I like. I also like Antrim. Fizgard is a big MIC on Vancouver Island that we use a lot. Frankly, there's a lot of them, and Amy in my office honestly would know more than I do on which mix exactly we're sending a lot of our business to right now. But a lot of it goes to the mix that we find the easiest to work with. And as a broker, Antrim is one of the easier, more broker-friendly ones, I guess. Neighborhood is pretty good too. They usually have pretty good terms and are pretty low risk from an investment perspective. As an investor, Neighborhood Holdings is a pretty good one to consider. Ian, great presentation. What other option would a lender/borrower have on a first mortgage other than interest-only payments? So you can, of course, do amortized payments if you want. You could do, some lenders do 40-year amortization, some do 25-year, 20-year, whatever amortization you choose, you can actually do. But one of the allures for borrowers going to private lending is, yes, the rate is higher, but because it's interest-only, the payments aren't that much higher. So that's something to consider. Patrick, I'm applying for a mortgage with a net worth program as a MIC and eligible asset. That's a really good question. So if you are self-directing your RRSPs and you can get an Olympia Trust statement showing that you have money invested into a MIC, then the answer typically is yes. It really depends on whether you can produce statements to verify the assets or not. And you often, in net worth programs, you often have to verify the net worth has been there for a certain period of time. Sometimes, however, the lenders will deem that these are not liquid assets because there are sometimes restrictions on your ability to liquidate those investments. And so it actually depends on the lender's program. Some lenders will allow it and some lenders will not. And so that is a deeper question, and it actually kind of depends on which lender it is that's dealing with your file, Patrick. So that'd be something that I'd be more than happy to help you out with a little bit more on an individual basis. Doris asks, how does investing with a TFSA work? It's very similar to using an RSP. You can self-direct your TFSAs and invest them into different things. It's just, again, it's less commonly put into mortgages just because the amounts in most people's TFSAs just aren't significant enough. And my personal take on it is if you only have 50 grand, it may not make sense to be investing in mortgages. Maybe it's better off that you're investing in something else, something that's a bit more liquid, perhaps. Cindy asks, is a general services agreement a solid due diligence for a lender? So if you're looking at a GSA, I mean, it's good security, but for due diligence, again, the due diligence really is more on the appraisal side. So the property appraisal is the #1 piece of information you want. #2 would be application, and #3 would be credit bureau. That's kind of the order of operations on due diligence that you definitely would want. But a GSA is something you can ask for. It is a bit aggressive, and so some lawyers on the borrower side will deny the GSA. So you just have to be careful of that, because a general security agreement is a pretty wide net to cast, saying, hey, if anything happens, I can claim anything of yours. Thomas has a question, as a borrower, can I use money lending for my 20% down payment with an A lender? So technically you can. The only challenge is that it may be hard for you to debt service the payments with an A lender if you're borrowing the down payment at 7 or 8%. So the payments might be too high for you to then qualify. So ideally, you'd probably want to try to get a refinance with an A lender, because you'll get a lower payment, and of course, you're paying a lower interest cost. Okay, so Sarab asked the question, is interest income earned through private lending taxed at highest tax bracket? Interest income is a higher tax bracket than capital gains, for instance. So yes, it is a higher tax bracket. So that is something to consider for sure. Peter asked, what type of taxes does the lender have to pay? Is it considered income, or are there any tax breaks? So it is considered interest income, and there aren't really a lot of tax breaks for interest income. So that is a consideration, that whenever you're earning an income, usually there's not a ton of tax breaks for that. So that is something that that you would want to consider. Leslie asks, how much is the average private mortgage? Meaning, how much does it make? How much makes it worthwhile to do a private mortgage over MIC? You know, 200 or 300 grand perhaps is kind of a good number to start off with. Usually the private loans are just bigger in general. Whereas a MIC, you can put in a small amount, 50 grand, 100 grand, whatever the number is that you'd like to put in there. So it's hard to say, but yeah, 250, 300 is a good number. It's going to get you enough deals coming across your plate that you're going to be able to place something. Most second mortgages that we do, most of them are between 100 and 250. And what is the average loan amount in private lending? My average loan amount in private lending is probably closer to $500,000 because we do a lot of first mortgages. But I do find that on first mortgages that are fairly cookie cutter, a lot of the time we're going to larger MICs to place those because they have a larger pool of funds. And a lot of private investors don't want to do a first mortgage where they're going to get 6% interest on their money, and they're exposing $500 or $500,000 of their cash. So I do find that our private investors are usually looking for slightly higher risk than what MICs do, slightly higher interest rates, or second mortgages where the returns are a bit better. Peter asks, if there is a private deal that goes south when going through you, will you handle hiring the lawyers, day-to-day communication, and all the work regarding the foreclosure and just notify the costs to the investor, or is that type of arrangement only through a MIC? So that is mostly through a MIC, Peter. That's where the MIC would handle most of that. I will say this though, we don't just drop the ball and just run away and say, hey, we're not going to handle this for you. Typically, if this comes up, then we would, if you don't have a lawyer, we'd connect you with a lawyer, we'd explain the situation, provide all the paperwork necessary to do that. And also it's on us to call the borrower and try and figure out some kind of resolution before it even gets to lawyers. At a certain point though, we do have to hand it off to the lawyer because there's a certain point where we can't do anything. And the lawyer of course can CC us and keep us involved, but I would say that the responsibility eventually gets passed to the lawyer to take it across the finish line and to update the client and the individual. Again, I haven't been involved in that type of situation, and I can imagine that I probably wouldn't want to just let it go. I'd probably want to see it through and help the deal across the finish line. But it's also not necessarily our responsibility to do that. But I imagine that if something like that came up, I would probably be more involved than our responsibility would be. Christine has a question. How long does it take to set up a HELOC? At what point do you set it up? It's always best to set it up as early as possible. The reality is it takes, some lenders are only 1 month to get a HELOC set up. Some lenders are taking 3 or 4 months to get a HELOC set up. So it's usually best to get it done before you need it, because if you do need it, all of a sudden you say, oh, I've got this great opportunity, and now you have to wait a month for the lender to do your refinance, or 2 months or 3 months. The problem that we've actually seen in the residential underwriting space is that lenders are really backed up, and refinances do not take the same priority as a purchase does. And so they sit there and sit there and sit there. So with people looking to access capital, getting the HELOC set up, other than the setup fees of an appraisal and legal fees, you're not paying interest on the money until you use it. And so we always tell people, go get access to the capital before you need it, because then when you do need it, your ability to write a check is really important, especially if you want to do private lending. A lot of times these borrowers need the money right away. And so if you have the ability to say, yep, I can fund that in 5 business days, okay, well, you're probably getting that call where somebody else that needs to go get their line of credit set up, well, there's just not enough time for that. So Luke has a question. Can you talk about third mortgages? Yes, I of course can. And you can go fourth, fifth, you can go a lot of different positions if you want. I've seen fourth mortgages, but I've never placed one, but I've seen fourth mortgages before. Basically what happens is when a first mortgage gets placed, if you have a second mortgage behind it, what ends up happening is if in the event of a foreclosure, the first mortgage holder gets paid all of their money first before the second mortgage holder gets to see a dime. It's the same thing for a third. So you're in third place. So first, the first mortgage has to get paid out, then the second mortgage holder gets paid out, and then the third mortgage holder gets paid out. So ideally, you want to be in first position. Of course, that's giving you more say in the situation. The other issue that sometimes can come up is if you are in second position and the borrower stops paying you, but is still paying the first mortgage holder, then it can be harder to foreclose because the first lender may not agree to foreclose with you, which means that sometimes you'll see that some lenders that are going behind a really big first mortgage don't like to do that, because the only way that they can force a foreclosure is actually to buy out the first mortgage, basically give the first mortgage holder what they're owed, and then they can now say, okay, now my second slides into first, and now I'm going to initiate foreclosure. So it's something to keep in mind, and that's why second mortgages are higher risk and higher reward too. They're a higher interest rate to offset that risk. Is private lending considered passive income and taxed at 50%, whether in a corporation or private? So it's considered interest income, which I don't believe is taxed at 50%, but that's something you'd have to check with your accountant. I don't believe it's taxed at 50% though. But if it's in a corporation, I expect it would probably closer to the 50% mark. But it is passive income. Are there any situations where there's principal and interest payments like A-lenders? It just depends on the lender and the borrower, but it's pretty rare. I find there's a number of different reasons that it's interest only, but most of the time they're interest only because the borrower wants a lower payment. And on top of that, a lot of time the lender, it's easier if you lend out 500 grand and they're going to pay you out, it's 500 grand. It's just easier to understand how much money you have owing. If you don't have just interest only payments and it's an amortized mortgage, then you have to run an amortization schedule and figure out, oh, on this day, exactly how much money is owed to me. It gets a little bit more complicated. It's just way easier accounting if you do it interest only. So that's why most lenders do it, especially individual private lenders. Sometimes a MIC might be more inclined to do a 40-year amortization just so that they slowly reduce their risk. But they have better back-end accounting systems that can track all of that more than your typical individual. Leslie just said, excellent presentation. Thanks, Leslie. Armand, the HELOC still needs income qualification, or can you get it as long as you have equity in place? So no, the HELOC would still need, you're going to get a mortgage, and so therefore you'd have to qualify for that. It's not just income verification. If you have a strong net worth, you might qualify under a net worth program. There are different options for that, but in general, most of the qualifications of getting a HELOC is based off of your income. Okay, so I got through all of the Q&As. Now what I'll do is, I'm sure there's some questions that probably popped up in the chat, so I'll start to go through those. And again, if anybody has any other questions, feel free to put it into the Q&A. Let me just take a look here. There's a question about who keeps the fees, the broker or the lender. So the lender fees, when we were talking about lender fees, that would be the lender that keeps all of that. The broker will charge a fee on top of any fees that the lender gets. And in general, the lending fee is usually 1% of the loan amount. That's pretty standard. Let's see here. Just seeing if there's any other questions that that anybody asked in here. What level of due diligence do you do on behalf of a private investor? Is there a lawyer you recommend to paper these deals? So in general, what we find is we're using the front end. We're usually asking for the full gambit of documents. So we get an application. We're also usually getting support documents too, to try to fit the client in with an A lender or a B lender. And if we can't, then we usually go to private. So we actually do get more documents than your standard client, because we always ask for documents up front before we do anything with the client, which means that we've usually reviewed their income and we understand what is their story, what is their situation here. There are some lawyers that we do usually recommend for these types of transactions, and so if you send me an email, I'm happy to send that over to you. But certain lawyers that we find are just good for representing the borrower. And some that are good for representing the lender in these types of transactions. Okay. Sam asked, I'm interested in the private lending list. So yeah, Sam, it would be best if you send an email out to info@greenmortgageteam.ca and just let us know that you're interested in learning more about being a private lender, and we'd be happy to send you more information on that. And then I have another Q&A question. So do you have second position HELOC lenders? There used to be a couple of lenders that used to do this, and it seems like pretty much every lender is now not really interested in it. Usually what ends up happening is you end up redoing your mortgage, or you stick with the same bank that you're already with and you add it on. We do have some clients that are sometimes stuck though, where they're with a lender that's a non-bank lender that doesn't allow you to break the mortgage, and they're very restrictive. But in most cases, most of our clients just have to break the mortgage, because there were a few lenders that used to do it, and nowadays it's just very, very difficult to do that. Cool. Are there any other questions, guys? I've answered all of them. Cool. Well, it's great to have everybody out. Thanks so much. I will conclude the session now. All the attendees will be emailed a copy of this presentation. So thanks so much for coming out, and I look forward to seeing you guys next month. Thanks a lot.